Hi, I'm Eric Burkholder here with Jordan Bradford, Senior Advisor at Burkholder Wealth Management. We're doing this video today to give you a quick update on the market and economy.
Yeah.
Closing in on the year here, a busy year as usual.
Mm-hmm.
Lots happened, and a lot of speculation of what will happen going forward. So, Jordan, maybe kick us off with some updated numbers on what's happening.
Yeah. So if you've been paying attention to the markets in the last handful of weeks, you've noticed that it's been pretty green, which has been kind of a 180 from our last market update at the end of the third quarter, where September we saw pretty lackluster month, and even into the start of October, the markets seemed to maybe kind of coming back down a little bit. But the second half of October and November were really, really strong. So it's 5 straight weeks of winners or winning weeks for the Dow Jones, the NASDAQ, and the S&P 500. So that's obviously a good thing. We're never going to complain when we get 5 straight weeks of winning markets.
Yeah, I think have or almost have gained all the losses from October back. I don't know off the top of my head, but it's close the last time I looked, and just tells you how quickly the markets can move.
Yeah, and even if we look at where the markets are at year to date, really great numbers. We have the NASDAQ, of course, leading the charge this year. After a very, very poor performance in 2022, the NASDAQ is positive now, 37.8% this year.
Yeah.
Which is pretty wild that it's gone up by that much after such a bad year last year. But to put that in perspective, if you go all the way back to January of last year, the NASDAQ is actually still down 8.71%. So even with a nearly 40% return this year, if you were a really heavy NASDAQ focused or tech style investor, or had a big chunk of your portfolio maybe in large growth companies, you're probably not necessarily looking back at the last nearly 2 years now and having a real great experience as an investor. You've had a wild ride, and you're still down potentially upwards of 9%.
Yeah. Great point, because I was actually pulling some of those numbers as well. I think it's so hard for investors and advisors and people that do this professionally to get caught up in what has done well and not, it takes a computer to calculate, compound annual return. We probably all have to do it by hand in school, but it's difficult and it's not intuitive.
Right.
And to what the point you just said, and I actually pulled 3 years of numbers. And so on a 3-year annualized basis, large U.S. growth, which is mostly NASDAQ, kind of NASDAQ-y type funds, is actually annualized at slightly negative.
Wow.
On the 3 years annualized through yesterday.
Wow.
It was like 0.9 compared to S&P or blend, which was about 8% annualized. And then value, some like small values up 15% annualized the last 3 years. So it's wild to think of an asset class can be up, what'd you say,
37.8%
in a year and be down on a 3-year. And that is how volatility hurts returns. And so we always encourage, probably the top performing asset class in any year is probably not where you want to be.
Right.
Because it's going to do the same thing on the downside.
Yeah, and if you were a retiree or a new retiree and your portfolio was really heavy, maybe NASDAQ style stocks, and you thought, well, this bull market and this is going to continue to run, you're having an even worse experience, because now are you not only having a slightly negative 3-year return, but you're also then compounding that loss with distributions out of your portfolio potentially. So you're eating away at a portfolio that's not really performing the way it's supposed to, which is why we really preach diversification. And we don't want to be heavily concentrated in one very specific sector, but a lot of people are, and more people are finding themselves with portfolios that are pretty heavy in the top handful of S&P 500 companies, which also happen to be some of the biggest companies in the NASDAQ as well. And speaking of the S&P 500 for the year is up 21.5%, and also a great year by any real metric. That's a wonderful year. We still have about a month left. But if you go back to January 1st of 2022 for the S&P, it's also down as well, about 3.85%. So even there, you're still seeing a little bit of a drag. And it just goes to show that last year the S&P was down about 21%.
Right.
This year it's up about 21.5%. But yet you still have that negative return because the down year happened first.
Right.
So when it comes to sequence of returns, you'd always prefer to have that positive return first.
Yeah.
But in this case, negative year last year, so S&P is still down a little bit. The Dow Jones has had a what I would argue is a maybe more comfortable ride the last 2 years, only up 11.7% this year. So definitely the lagger of the three. But going back to January 1st of last year, the Dow Jones only down 0.31%. So if you were looking for the smoothest ride, the Dow Jones would have been the index that would have closely matched that more comfortable ride in the last 23 months, as opposed to the S&P or even the NASDAQ would be a very, very wild ride if you were relying on that money for income.
Right, exactly. And obviously the way we run portfolios is a value-based strategy, which is has some similarities with the Dow, but I think the theme there is we're going to own everything, and our job is to craft those portfolios and change the allocations in a way we think will maximize return for a given level of risk. But you can't just put all your money into one of these,
right?
Okay? Because on any given year, 3-year, 5-year, 10-year, you'll have differences in performance. And to your point, we really have to smooth that ride out, especially, either if you're retired or eventually want to be retired one day, which I think is everybody, you need a dependable, as smooth a return stream as possible. We know we can only control so many things, but diversification is certainly one of those.
Yeah, and I think most people would prefer to have some exposure in an area of the market that's doing really well. Like this year, there's nothing wrong with having a small sliver of your portfolio that maybe is a bit more on that aggressive side and own a few of those, more techie style investments. But you can see the problem when you get too heavily concentrated there is you still have almost 9% you need to gain back without any other losses before you're going to break even over a 2-year stretch. And that's tough. That's a tough pill to swallow if you need that money in a shorter period of time potentially.
Right.
And the other thing is that this can happen at any point in time. There's we're looking at a market right now where we briefly entered a recession last year, 2 straight quarters of negative GDP. So technically a recession.
That's how we define it.
But I think there's a lot of folks who thought that we were going to hit maybe a more traditional style recession this year. That hasn't happened. In fact, GDP is significantly up from where people expected it to be this year. But the longer we go without experiencing a traditional recession, I think the more concerns that come into play with having a portfolio that's too heavily concentrated in one area. Because if the NASDAQ can be negative 9% nearly for 2 years, just negative by almost 1% over a 3-year period. Imagine if we had a recession, maybe in the next 5 years as well. Those NASDAQ numbers could look pretty paltry here in a handful of years. If you're too heavily concentrated there, it could potentially hurt.
Yeah, exactly. And shifting gears slightly, but you mentioned GDP, and so obviously every asset class for the most part is having a good year this year. I remember people promising us a recession at the beginning of this year, guaranteeing it. So what happened? Because I think that is going to be the story behind how the markets have performed as well.
Yeah, we went from last year having 2 quarters where GDP was negative. We got out of that last year, but the market or the economy was maybe, I would say treading water at best last year. And even when we headed into the beginning of this year, in the second quarter, GDP was only 2.1%, which is good. We won't complain for positive, yeah. but it's nothing to write home about. It's not emblematic of a booming economy, if you will. But this year, this quarter, we had a recent update actually. It ticked up even higher now. GDP through the end of the third quarter, annualized estimate is 5.2%. And these were just the most recently updated numbers. So, that's way different and much better than what everybody was talking about going
Right.
into this year.
Yeah.
I mean, I don't think I saw a single analyst estimate
No.
where anyone said, "Hey, I think GDP is going to be north of 5%."
Right. No, that's not squeaking by. That's well out of recession.
Right.
And regardless of, I'm sure there's different takes on the reliability of that data, but that's the data we've always used. It's calculated the same way, and so pretty remarkable, especially also given where interest rates are. And again, just goes back to our story of, we obviously are tracking this. We're aware of it. We're making long-term strategic allocation decisions in the portfolio. But if you're making investments based on what's going to happen to GDP this year or any year, that is an absolute recipe for disaster.
Yeah.
So on social media, I like to track, these predictions, and I save these posts, and it's always fun to go back and look because they're never right. And of course, this year, beginning of the year, there's multiple ones that are like, hey, you should, here's the 5 reasons why we're going to guarantee to be in a recession in the next 4 to 5 months. And then what's worse about it is they're also saying, and you need to put your money in cash, or you need to put your money in T-bills. And as the numbers we just went over, that would have been a hugely costly mistake that, it just, we have seen this time and again, you almost never get that back.
Right.
It's just gone returns. It's going to affect your return for the next 5-10 years. Because if you missed out on, if you're a U.S. growth heavy and you got out and you missed that 30-something% rebound, you're not slightly negative for 2 years. You're now real bad. And
Yeah,
so,
you're still looking at at the end of last year, those large U.S. growth heavy investors were staring at a nearly 50% return they needed to get back to even. I mean, that's why you're seeing, even with a 37.8% return, you're still down almost 9%. You need a lot of work to get out of those holes. So yeah, the business of predicting markets is a bad business to be in.
Yeah, and we have, so GDP looks much better than we anticipated. Interest rates are still high, but there's silver linings there as well. It seems like inflation has moderated. Hopefully that continues. And it seems like we may be kind of at the top of the interest rate cycle.
Yeah.
And again, we don't know, but I think an interesting stat that I found today was so the Fed funds rate is roughly 5.5% target rate right now, which for our human very short-term memories, that seems incredibly high. When just a few years ago it was 0.25%. But you know what the long-term average is over all the data we have? 5.98%.
Wow.
So we're actually below the long-term average. So
that's
and
good.
I think, again, I'm not trying to predict what's going to happen, but we all can remember extremely strong economic cycles, markets, and that has been when interest rates have been much higher than where they are at now. So I'm sure there will be more adjustments in real estate and things very specifically tied to real estate or to interest rates, but overall, higher rates, or even average rates, we can still have really good markets and economies.
Yeah. And one thing I can promise you is that going into next year, you're going to hear a lot of people online or in the news media who talk about markets who are going to talk about how, yes, the numbers have been great in 2023, but here's why it's going to be so bad in 2024.
Oh, yeah.
We hear that every year. There's always, some prominent person, usually a vast majority of prominent vocal market commentators, if you will,
Right.
Out there talking about all the doom and gloom and why this is the year there's going to be a recession, or this is the year where the markets are really finally going to take a hit. And I think the important thing is we just kind of pay attention to what the data is telling us. The data says right now that the economy is actually humming along pretty nicely.
Right.
Doesn't mean that it'll do that forever. It'll change over time. It always does. But we're in a pretty good spot here as an economy. The markets are doing much better this year. We still have room to go even before we break even. So as good as this year has been, we still haven't gotten back up to the highs we were at in January of last year. So there is still a little bit of room before we even just get back to where we were before all the volatility really started to get amplified. And for what it's worth, next year is a presidential election year, which historically have been positive more often than they've been negative.
Yeah.
So, I think that, I would take a big deep breath before you think about changing your portfolio dramatically to anticipate something that you hear on the news, whether that's, this election's going to be different.
Yeah.
I say that every 4 years, actually. Every 4 years
Right.
it's different. Or that, now finally the economy is going to, come to a crashing halt, or some crazy headline like that. You're going to see a lot of it. But just take a deep breath before you make any big changes, because as you can see, making decisions based on an analyst's projections of where the market's going to go can be really detrimental.
Yeah, and I'm sure we will absolutely have more videos in the future and next year on elections and how that affects or doesn't affect portfolios. But you got to keep everything in perspective.
Absolutely.
I think that's the quick update for you guys today. Let us know if you have any questions, as always, and we will see you on the next video.
Thanks.